Hey traders, this is Ron Hayden at Market Tamer. Happy Tuesday. Hope you guys are having a great day. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. We'll kick off here with the IWM small cap ETF. Down 1.21%. It's been underperforming the market. We know that because the SPY, the Qs, and the Dow are up there near all-time highs. But we still have an inverted head and shoulders. However, with the market rolling over today, it quickly led the charge. It didn't go down the least, it went down the most with its partner, MDY, which are the midcaps. It also went down. So MDY is doing a little better technically than the IWM, but the point is the small midcaps, first down day here in a little while, and they just quickly roll right over. Now, inverted head and shoulders are still in place, but if I was going to watch the market for a reaction on a day-to-day basis, it wouldn't be those two, it would be the broader market. The S&P 500 ETF, the SPY, it was down a lousy 0.5% today. The 5-day EMA is the blue line. That's just a really short-term outlook, and we're about 5 or 4 cents below the 5-day. It's not that big of a deal. I would continue to want to watch the red line, which is the 20-day EMA, and if we get below that, that's what raises that yellow flag. That would catch my attention, and immediately we go to the 50-day as the target. So SPY lost 0.5%. Diamonds lost 0.6%. They're below their 5-day, still above their 20. You can see the red line, that 20-day EMA. It was broken back in the early part of March, again at the end of March. So it hasn't been following that very much or very well. So by default, I would instantly go to the 50-day. So yeah, below the red line would be a little concerning, but the 50 days were the real line in the sand would be for the bulls. And then if we take a quick look at the Qs, they were only down just over 1/3%. They're still above their 5-day and almost back at those previous highs. All right, so outlook is still bullish this week. We start losing the red line, I would get a little more cautious. I get asked a lot about trailing stops and how I would handle them. So I think a great example of that would be, let's look at the seasonal trade ideas that I've been saying to you guys since, back on March 21st when I did my first 2-for event, when we brought a whole bunch of trade ideas to the surface. Some of those were Amazon. And when I'm going to do a seasonal bullish trade idea or bearish, but these are bullish, I think the red line, the 20-day EMA, for a momentum perspective, if you're above it, it's bullish. If you're below, short term, it's not. So even though Amazon was down $14 today, it's still above the red line. So if you go back into March 21st or even sooner when Amazon was in its bullish window, it's staying above the red line. Until it gets below the red line on an end of day basis, it's still in a bullish technical posture. So I wouldn't be looking to exit. That would be me. I can't speak for you. How about EDU, New Oriental Education? Market was down. This one was up over 2% at one point today. The red line would be a trailing stop. Since the 21st, when I first brought some of these trade ideas to you, the stock was what, around 81 bucks? Now it's almost at 91. Not bad. How about Home Depot? It was down $2 plus today. If I zoom in here, look at the 21st. The stock closed around 190. Now it's just over 200, $10 more. It's even above its 5-day in blue. It's nowhere near its red line. Again, the red line would be the end of day or trailing stop. How about the little blue box? Tiffany's. The 21st was here, closed at 100, went literally in a straight line right to 107, hits the 200-day moving average. How interesting is that? Stopped cold. That's okay. Red line's a trailing stop. And keep in mind, in all of these trade examples so far, in the financial webinar, I gave you guys some stuff to play around in paper trading. For example, if we buy 3 long calls in a paper trading, virtual trading account, first one's off at 20%, second one's off at 100%, third one is off if we get below the red line. And at any given point, if we get below the red line, the whole trade idea is closed, no matter how many are open, whether it's a win or a loss. So if you take that back to Home Depot, that's another great example, right? Nowhere near the red line. EDU is already a triple-digit winner from the 21st. So now it's only 1/3 is hanging in there, that last of the 3 long calls, right? Well, let's go on to CTRP. How's this one doing? Seasonally bullish window. What a shocker. Stock gaps up. And it's still pushing higher. Today it was only down, 65 cents, but still above its 5-day. Again, the red line, just like here, would be the trailing stop. And then the sixth one was ULTA. Stock was down $6 today, almost 2%, but it's still above the red line. Again, another earnings bias with the stock moving higher. So there's a review of those trade ideas we were talking about. I hope you find this helpful. Again, play around in paper trading. It's amazing, amazing stuff. Here's AVYA. This one is in today because despite the market being down, it was up over 4%. Nice spike in volume, and it cleared 18 bucks, which was a peak beginning of December, mid-December, February before the earnings report. Then there was the gap up at the end of March last month, and today we cleanly got above it. Target, frankly, back up there almost at 22. For a little $18 stock, that's a big move. How about XOG? I don't think we've ever looked at this. This is extraction oil and gas. The stock was in August at 15. Then it was down in the 3s. Talk about a haircut. But here's the interesting thing technically. While we're not seeing massive volume like we might have seen over here or here, we're still getting a little bit of above average volume. Closing near the highs of the day, we took out the $5 mark. Today we were down 6%, 34 cents, but it's not that of a well-known company. But here's the point. I could consider using a red line as a trailing stop, the 20-day EMA. As long as it stays above there, the technical target might as well be the 200-day. It's over 50% higher. I am not saying it's going to get there at all, but that would be the resistance point on this chart. And I keep getting questions about Boeing. Again, I'm going to reiterate the idea that once this happened, it was protective put time. Yeah, we had a rally, and now we're right back down to where we were. If this thing breaks the 200-day, down here's the target. Keep in mind, it may not be very nice and allow us as traders to watch it and then close below the purple line. We wake up the next day and decide we want to be bearish. What's probably going to happen is it's going to be news driven, and it's just going to go from here to somewhere down here, then the trade is over. So if I had shares of Boeing, which I don't, but if I did, I'd be thinking about a protective put right about now. It's still way, too much is unknown. All right. So with that, I wish you guys a great rest of the day. I'll see you in the next video.